Today I'm going to cover the American consumer is tapped out. The stock market, the direction of the market, and the Fed. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 21st, 2024. I'm going to begin with a piece from Adam Taggart, and is interviewing Stephanie Pomboy. She is the CEO and founder of macromavens.com, sells her research to Wall Street firms, very well regarded in the industry. I always enjoy listening to her because she's thoughtful, she's, in my opinion, accurate. I don't know about her track record, so I assume that's good because Wall Street firms would not continue to buy her research if she weren't. But she talks about the American consumer being tapped out. What I'm thinking is people who make, I'm not talking about wealthy people, and I'm not talking about poor people. I'm talking about people who are kind of in the middle, who make a good income, should be enough to make a living on, even save some money. Inflation, just the cost of everything, is pushing down on earnings. Earnings are not keeping up. So people are having to, they just don't have any disposable income. And in some cases, they're having to rely on credit card debt, which they don't want to do, I would assume. And that's just what's going on. And I suspect many of you are in that boat, and where you are really feeling the effect of inflation on your earnings, your disposable income. So take a listen to a very good interview between Adam Taggart and Stephanie Pomboy.
What's your current assessment of the global economy and financial markets?
Well, I guess my assessment, at the risk of sounding like a broken record, is pretty much the same as the last time you and I huddled together here. And that is that I am convinced still that the fastest interest rate hikes in our economic history are going to have real consequence on the economy and the financial sector. And we are seeing that play out. But so far, it's been sort of poo-pooed or generally dismissed as temporary and problems that will be resolved as soon as the Fed cuts rates. Never mind that seems to be getting pushed farther and farther out into the future. So I continue to believe that we are going to see a real slowdown in economic activity, and we will see problems around servicing debt at these substantially higher interest rates, both on the part of consumers and corporations. Meanwhile, all the consternation around debt service seems to be singularly focused on the federal government, which I think is the one group that you really don't need to worry about because they have access to a printing press in the form of the Federal Reserve and the power of taxation. That does not apply to consumers and corporations. So they're kind of, flying without a safety net, unlike the government. So, I continue to be focused on debt service issues in the consumer and corporate space, and the knock-on consequences for the creditors who have extended that credit to them. And a broad slowing in economic activity. So, boy, it all sounds pretty gloomy. And unfortunately, that is sort of my central thesis, is that we're going to have a substantial slowdown, and we're seeing signs of that emerging already.
Stephanie Pomboy covers this about the government debt, but she says the government's kind of got it easy because they can print money and they can borrow money. And so, but the consumer cannot. And businesses do not have they can't print money, and they have only so much room they can borrow money. So it reminded me of the U.S. debt clock. So I thought I would go through that and show where the consumer and the government are tapped out. So this is the U.S. debt clock. You can get there at usdebtclock.org. And I highlighted, some of these don't show up very well, but in the upper left section, I put a black box around the total U.S. debt. Now, this says $34.7 trillion. So I can't relate to a trillion. I don't. So 34 trillion, I don't relate to it. It's a lot of money. It's going up a lot every day, every year, but it's not going to go to the moon. We know that, but it keeps going up. And the government keeps on spending money they don't have with no intention to pay it back. Um, to the right of that is a pink box which shows the revenue. The government is taking in this fiscal year 4.8 trillion. Back to the left, second line, is a blue box. The government is spending 6.6 trillion. The difference between those two numbers is 1.8 trillion. So we are going backwards 1.8 trillion per year. So the 34.7 will go up in the next year 1.8 trillion approximately. So where does it stop? I mean, this makes no sense to me. And by the way, before we start throwing rocks at the US government, all the other governments are doing the same thing. You can't name a major country, and most countries you've hardly heard of are doing the same thing. And there's a handful, literally a handful, that don't do that. But most do, and most, their debt to gross domestic product, or their debt to economic output ratio is similar to ours. There's, I think, about 7 or 8 that are worse than us. So everybody's doing the same thing. It's not sustainable. A reset, a currency reset, an economic reset, a collapse, whatever you want to call it, is in our future. This will eventually, the weight of this will cause a collapse. I think it will be worldwide. I don't think it's around the corner. I think we've got some runway before this happens, is my opinion. But somewhere in our future, it is not a pretty picture. So when you go all the way to the bottom center of this chart, you see the US credit card debt, 1.3 trillion and climbing. So this is not good for the US. It's not good for the consumer. And it goes back to Stephanie Pomboy's comment, the consumer is tapped out. And when they're tapped out, where do they go? They have to go somewhere to live. You got to buy food, you've got to buy fuel, you've got to pay your rent and your utilities, etc. You just have to. So what do? You go to the easiest place you can. You don't want to have that. You want to pay it back. But 1.3 trillion and climbing of credit card debt. I think the biggest culprit is inflation. That's where a lot of this rests. Now, there are probably some people who borrow money indiscriminately and not prudently. Okay, that's possible. But I think a lot are wise people who are just trying to make ends meet. And is inflation the culprit? Is that coming down or slowing down enough so that this gets reversed? Doesn't appear to be. So next I want to play a piece from Scott Wapner interviewing Joe Terranova. And Terranova makes the case for the fact that we are in an AI-driven market. AI and companies that use AI or develop AI, they are doing very, very well. It doesn't seem to be slowing down, and it is actually driving the market. So those companies, you could call it the Magnificent Seven, or you could extend it to 10 or 20 or whatever, but the top companies are literally driving the market. And when you get, let's just look at the S&P 500. When you look at the S&P 500, the bottom 100 of the S&P 500, now this is not the bottom 100 of the stock market, this is of the top 500 in size. The bottom 100 of that are negative earnings, primarily negative earnings. And so they are, kind of in a way going backwards. And then how many companies are below the top 500? A few thousand. What are they doing? Again, some are doing well, but I think a lot of them are not doing well. We are in an economy that is slowing to some aspects of the economy, but other aspects, the AI-driven aspects, it is growing substantially. I won't say it's exploding, but it's definitely growing substantially, and that is what's driving the market. Where a lot of aspects of the economy are slowing, these are accelerating, and it makes it look like we're in a growth economy when in fact we're in an economy that is actually struggling. So take a listen to Joe Terranova.
It does take us to our talk of the tape. What is next for stocks? Let's ask Joe Terranova of Virtus and a CNBC contributor, Ayako Yoshioka of Wealth Enhancement Groups. Great to see you both. Aya, you first. So here we are. Now what?
Yeah, it's a great backdrop. You know, we've had a nice rise in markets. Equity markets have been calmed down by the inflation print from yesterday. And so I think it's a good backdrp for stocks.
Joe, what do we do here? We top out? Do we keep going? Is there a message in how we rebounded and so severely from the April lows?
There absolutely is a message in how we rebounded, and it's about core profitability, margin expansion, and think about it. We set the lows heading into the earnings season. It's been all about coming out of the earnings recession that really has been the catalyst behind the appreciation to new all-time highs, and I think we all collectively really have to breathe a sigh of relief from where we were in 2022, that we have the advancement of this technological innovation surrounding artificial intelligence and generative AI, because that has been the fuel for this bull market. I think it's well entrenched. And you asked, what are we looking for or what are we hoping for in the near term? I'm actually hoping for a correction. Why? Because there are areas of the market, there's areas of technology that I don't have exposure, that I want to get exposure to, because I think the bull market extends well beyond this year.
Okay, Joe, I think that's the most important question for you guys today. Do I stay with tech, which has rallied the most since the April lows, right? It's up 12.5%. It's been reasonably broad, although, of late, obviously, technology has had that burst back. Utilities are up 10.5% since the April lows, real estate, comm services, and on and on and on. Do I stay with those top trades? Do I play for a bigger broadening? What do I do now?
I don't think that you could move away from technology, Scott, in particular as we head into NVIDIA earnings. I think the importance of NVIDIA earnings is on the entire AI halo, whether it's AMD, Broadcom, or Cadence Design. I think very similar to what Palo Alto delivered in February, when it was a disappointing report, but they get the benefit of the doubt. Let's face it, if NVIDIA gives us a disappointing report, they're going to get the benefit of the doubt. Buyers are going to resurface there. So, no, you don't want to move away from technology. And I think Apple taught us a very significant lesson, a very punishing lesson about if you move away from technology, we'll remind you about our balance sheet, the cash flows on our balance sheet as a reason why you don't want to do so.
Next, I want to cover Mike Wilson. Now, Mike Wilson is the chief U.S. equity strategist and chief investment officer of Morgan Stanley. Very smart guy. He's been voted by his peers to be the #1 money manager on Wall Street for many years, consecutive years. So he is obviously a smart guy, and they think highly of him. But when you go back a couple of years, this past year, 2023, and so far in 2024, he has been calling for a correction in the market. And originally he started by saying the S&P was going to go down to about, I think I even heard 3,000. Certainly I heard 3,300 and then revised 3,600 and then 3,900. So now, and so he keeps calling for this based on earnings. Now he has shifted to a position of bullishness, where he is putting a target of 5,400 on the S&P 500. So interesting. I have a high regard for Mike Wilson. I think he's a very smart guy, but it told me one thing. He uses fundamental analysis to make his predictions. It's called fundamental, using fundamentals, and in one of those cases, fundamentals is earnings. I personally don't use fundamentals. And the reason I don't is exactly what happened to Mike Wilson. Sometimes the stock market goes in a different direction than what the fundamentals say. Or if it does, it may happen 6 months or a year from now. Most people don't want to put up with losses or lack of participation when you want participation that long a period of time. So I use technical analysis, and I want it very sensitive so that as the market shifts, I shift with the market. If it's going up, I want to be in the market. If it's going down, I want to be out of the market. And by the way, if it's going up, I want to be in the right aspect of the market. That's how I view things. It's more tactical. It's using technical analysis. Mike Wilson does not, it appears. So, but anyway, I give Mike Wilson credit for having shifted. So I could not find a video on this. So I will just read you. He wrote a piece, or Bloomberg wrote a piece on him, and I just took an excerpt of a few sentences from that, and I'll just read those to you. I think it says it well. Morgan Stanley's Michael Wilson now sees the S&P 500 rising 2% by June 2025, a major about turn from his view that the benchmark will tumble 15% by December. The strategist, whose bearish 2023 outlook failed to materialize as markets kept rallying, finally giving in and boosting his target for the S&P 500 to 5,400 points from 4,500. That catapults his forecast from among the lowest on Wall Street to one that projects a fresh record for the index. So a big shift. Finally, I want to introduce a piece from Mohamed El-Erian, and he talks again about the Fed again being boxed in. They have this target that they've set. I think he calls it arbitrary, an arbitrary number of 2% inflation, but they're boxed in on, do they cut interest rates or when do they cut them? And we've gone from a forecast most people predicted based on what the Fed was saying, as many as 7 cuts this year, and now they're down to 2. And I don't even know if they're going to get to 2 because the market is not responding as they had predicted. So take a listen to this piece from Mohamed El-Erian.
There are 2 really problematic issues that we don't talk enough. How sensitive are the stubborn components of inflation to interest rates? They're not very sensitive. That's problem number 1. Problem number 2, what indications are we getting of the economy? It's slowly weakening. So it raises the issue that once again, the Fed is going to have to pivot, this time not on the basis of the inflation numbers, but on the basis of the real economy numbers. It will pivot yet again. And then there's the big issue that I know no one wants to discuss.
Go on.
And I insist, and I understand that fully, is the inflation target the right target? We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary. But I understand why no one wants to talk about this. But we should all realize that if we are pursuing the wrong inflation target, the risk of a mistake, and that mistake would mean sacrificing growth unnecessarily, the risk of that mistake is high, especially when the low-income people are most at risk.
I know how much criticism you get every time you bring this up, because you've been bringing it up with me for the best part of 12 months, maybe longer now. If we go back to the Jackson Hole speech from Chairman Powell in August of 22, when he talked about pain being required to get inflation under control, then the experience of the last 12 months where we all got seduced by this idea that maybe we don't need pain whatsoever to get inflation back under control. Are you saying that the pain that's required to go from 3 to 2 just is not worth the squeeze?
Correct. I'm saying that if you were to establish an inflation target today based on the secular issues, and let's talk about it, the domestic paradigm is changing. We're no longer in this Washington consensus of deregulation, liberalization, fiscal prudence. We are in a world of industrial policy, government intervention, and fiscal irresponsibility. Let's talk about the international. We're no longer talking about ever closer globalization. We're talking about fragmentation. Then look at the transitions we have. We have major transitions going on, not just generative AI, life sciences, and sustainable energy. You have things happening in healthcare. You have things happening in defense. You have things happening in food security. If you put all that together, it is a different inflation environment. It's a world that's subject to higher inflation. and we've come from a world that was subject to lower inflation.
Following on to that, I want to show you a couple of charts that make the case for the U.S. economy slowing down. So this is the Philadelphia Fed Manufacturing Index reported through the Fed. You can see the direction is going down. So the amount of manufacturing that's happening, this is a U.S. indicator. New orders, new manufacturing orders, same thing, moving in a downward direction. So what I'm saying is that the economy is slowing. It's not crashing. It could correct, it could correct. But I want to just say to you, you're an investor, I want to say to you, we are not in a growth economy. One of the things I talk about is being defensive in your investment approach. Out of last week or the last couple of weeks of videos, I have had a lot of very favorable comments. Thank you very much for saying what you've said. One person wrote and said, you talk about investing defensively. Could you give us an example of what you do to invest defensively? That is a very fair question. So it is a very hard question to answer on a video. So because here's why. People invest differently. So there are people, most people, invest in a buy and hold way. They put money in the market. It may be in stocks, some portion in bonds, some portion in commodities, etc. And so I can't give you a general comment when people are all over the place. Some people invest tactically. Okay. I'll try to give you some general comments about what I mean by that. If you are a strategic investor, you're investing in a buy and hold way. The defensive sectors, and there's a lot of things you can do. I personally don't think that this is an environment for bonds. The 40 years that went on from approximately 1981 to 2021 were generally a period of declining interest rates, declining bond yields, and increasing bond prices. During that period, bonds, that's where the people got this concept of stocks and bonds, that during that period of time, bonds were a good antidote to stocks. They were a good balance for stock risk. And so people put stocks together with bonds. Since 2021, what's happened is, as you know, interest rates and bond yields have started to go up quite a bit. And as a result, bond prices, bond ETF prices, and bond fund prices have fallen. They've fallen quite a bit, a lot. So the antidote for stock risk, meaning bond exposure, has not been helpful for most buy and hold investors. So therefore, personally, in this period of time that we're in, this macro period of time, I personally don't think that bonds will provide the level of protection that people want. The types of defensive assets or equity assets typically are utilities, consumer staples, healthcare, and you could even go over into an asset class such as commodities and precious metals. And you know that as I'm recording this, precious metals have been doing very, very well. I've been covering it for a period of time. Some of that period of time, they haven't done so well, but they are a defensive asset. So people who want, those are the kinds of things that you've got to figure out for yourself what is the right mix. I don't personally do buy and hold investing, but if you do, those are some ideas for you. I do tactical investing using technical analysis. And so I determine, based on our proprietary model, what is best. Some of you do as well. There are many, many technical indicators. I don't know how many, I won't say it's infinite, but a large number of technical indicators. I don't use most of them, so I could not go into that and make a recommendation on how to do that. One thing I will tell you and disclose to you, and I'll cover it more at a future time, is that we have always used technical analysis, and we still do. But on May 1, actually on April 30, going into May 1, I made a shift. So I had programmed our model into AI, artificial intelligence. And so we are now using an artificial intelligence backed model. This is now 3 weeks that we're into it, which is a micro period of time, doesn't tell you anything, but already we're ahead of our old model and we are ahead of the S&P. And that is due to AI. AI going in and figuring out what is the best thing to own and when to own it in this particular market. Things that I couldn't figure out, things that you can't figure out with a normal spreadsheet or program. AI is able to go in, and it's not perfect. I mean, you can have AI, and that doesn't mean you're going to be wonderful. It's how you use it, and has it been validated over a period of time? Is it effective? So I just want to disclose that to you. I will share more of that as we go along. Probably not every week, but from time to time I will share how that's working. But what I found in knowing a lot of people who are in my peers, who are investment managers, in talking with them, it seems that very few are embracing AI. I particularly think that AI will do the job of a lot of investment managers. I won't say it will replace them, maybe it will replace them. I think you either embrace this and use it to be more effective, or you're going to get replaced, because AI is a powerful tool, and the investment advisors who are charging the fees that they're charging, and what are they doing in investments? Yeah, they're available to counsel you on financial items. That's worth something, but you're paying a fee on those investments for what? What are you getting for it? So think about it. I think that's what a lot of people are looking at. And so AI, if it's used correctly and used well, yeah, I think it's a tool to help people invest more smartly, to minimize risk and to increase rates of return over time. That's what most people want. Investment managers and financial advisors don't want me to say this. They don't say that, Ben, because they want you dependent on them. So I'm just going to say I embrace it. I'm excited about it. I'm excited about what I see in the data and in the validation and so far in real time. But I think that's, in my opinion, the future of investing. So I wanted to cover that, and thank you for bearing with me. And again, thank you for your very kind comments on the last couple of weeks of videos. Okay, summarizing what we covered today, consumers and small businesses are more and more squeezed. The economy is slowing down. It is not a growth environment. Wages are high, but not keeping up with inflation. The Fed is boxed in a corner to get their inflation target inflation number down to about 2%. The Fed's underwater. I thought this was an apt cartoon. Where are they going to go? Increase rates, decrease rates, stay the same? Nobody really knows. But this probably describes the position that they're in. Thank you for watching. If you have questions or comments, leave them in the comment section below. And again, thank you for your kind comments.